Hey everyone, welcome back to Corporate Decoder, the place where we decipher those dense corporate filings. Today, we're cracking open KindlyMD's latest report. Don't worry, we will focus on the juicy numbers. You might say this report is not so kindly to their bottom line. Scroll, this Canal report on Form 10K contains certain forward-looking statements, Scroll. So what is KindlyMD anyway? Well, they're in their healthcare business, specifically aiming to reduce opioid use through personalized treatment plans involving traditional and alternative medicine. They collect tons of data, aiming to become a leader in value-based care. Scroll head of headquarters are located at 5097's 900E, Suite 100, Salt Lake City, UT 8417 Scroll. Q, they have a few locations in Utah, but is that enough to help their financials? Scroll reduces prescription medication use and addiction and is a valuable tool, Scroll. Their whole business hinges on integrating mental and physical health treatment with alternative medicine. What's interesting is that they are collecting a lot of data on why people are seeking these alternative methods. This data could be valuable for future treatment protocols and also to prove that more treatment options should exist in this specific market, even to the larger pharmaceutical industries. Scroll trading comp, symbol Scroll T1. Quick thing of note, they are indeed listed on the NASDAQ under the symbols CADLY and CADLYW. If you are trading it, keep an eye on these numbers and our analysis. Scroll revenue, cash streams, Scroll Kit. Let's see where their revenue comes from. Currently, it is mostly patient care, service agreements, and product retail sales. They also hope to get into data leasing, but that remains to be seen. Scroll payments couples are received from patients directly or reimbursed from Medicare. Medicaid, Scroll, the company offers specialized outpatient clinic services. Payments come from the usual sources, insurance, and of course some patients still pay out of pocket. They treated roughly 2,600 in 2024, slightly up from the previous year. It's essential for them to get reimbursed by these major payers. Scroll are processing of personal and healthcare data for these purposes, includes both automated and manual Scroll CBs. For the data they collect, they are already training machine learning, which may involve using AI to categorize patient needs and improve business. This could be a huge step to improving operations and patient experience. Scroll for KID, the fiscal year end Scroll. So let's look at the financials, which is the most important part of this filing. Let's look at the numbers for the years ending December 31, 2023 and... Okay, here's the headline. Revenues for 2024 were roughly $27 million, down from $3.7 million in 2023. That is a more than 25% decrease in revenue year over year. That's a pretty big drop. Operating expenses actually increased to $6 million, up from $5.3 million the previous year. This is a double whammy, lower revenue, higher expenses. And here's the result, a loss from operations of $3.3 million, much worse than the $1.6 million loss in the previous year. Looking at other expenses, interest expense skyrocketed to roughly $400K. What is going on there? That's a massive percentage increase versus the previous year. All of that translated to a net loss before income taxes of $3.6 million. This is almost double the loss of the previous year, so everything seems to be trending in the wrong direction. That's something to keep an eye on. One quick point on public float. As of June 30, it was around $8 million. We will talk about why this number is relevant in the analysis at the end. Let's check the cash flow statement. Cash used in operating activities increased significantly. They burned through $3 million compared to less than $500K the previous year. That is a dramatic change. Thankfully, they did raise cash through financing activities, but they can't keep raising funds forever. Scroll, if and was meet certain financial and liquidity criteria to maintain the listing of our common stock on the NASDAQ, Scroll. T are the report notes that we may not be able to satisfy the continued listing requirements of NASDAQ or obtain or maintain a listing of our common stock on NASDAQ. This is not good. This means that the company's stock might get kicked out of the NASDAQ if they can't meet listing requirements. This could further drive down the stock price and make it harder for them to raise money. Scroll, our business and operations would be adversely impacted in the event of a failure or interruption of our information technology infrastructure, or SIG, as with any company that relies on IT to function. There is significant risk related to cybersecurity and protection of private data. IT system downtimes, transactional errors, data corruption could be detrimental. This company takes it seriously. The company addresses cybersecurity risks through confidentiality, security, and availability of information that is collected by identifying, preventing, and mitigating cybersecurity threats. They even work with third-party firms to do evaluations. Scroll laws and regulations affecting the medical cannabis industry are constantly changing. Scroll. Here's a big risk factor. Laws and regulations affecting the medical industry, including cannabis, are constantly changing. There is also a risk of potential FDA enforcement on CBD products, a potential risk due to the combination of state and federal law, so keep an eye on this. Scroll increased scrutiny of pain management clinics, including ours, Scroll. And another factor, there's increased scrutiny of pain management clinics due to the opioid crisis. Any mismanagement of opioid prescriptions could lead to legal problems. Scroll Keep shell company Scroll. The filing also specifies they are not a shell company. This is legal jargon, but it basically means they have real business operations. So what's the story? KindlyMD is facing some serious headwinds. They have a compelling mission, but the financials are not pretty right now. Declining revenue, increasing expenses, and big losses raise concerns about their long-term sustainability. They are trying to pivot from cash payments to insurance payments, so that may be why they had a temporary setback. That said, the growing chronic pain market and potential for data monetization offer opportunities. They need to execute their strategy flawlessly and ideally need to raise more capital without heavily diluting existing shareholders, which is a tough spot to be in. This company needs to turn things around quickly. The company's small public float might make the stock price very volatile. Given these risks and the current financial picture, the stock is a gamble at the moment, to say the least. Thanks for watching. If you enjoyed, please subscribe, like, and comment.